So today we are going to talk about one of my favorite life insurance companies when it comes to whole life insurance policies set up for maximum cash value, and that's Guardian. If you were to ask me why would I choose Guardian for my life insurance policy, there's really two main reasons. Or to rephrase, there are two reasons often why a lot of people choose Guardian. The first is that they are one of your four major mutual companies. And what that means is that they have a track record of delivering strong actual cash values to policyholders, not just projecting great looking numbers and then under delivering, which is a common problem when it comes to whole life insurance policies, where when you look at your four major mutual companies, when policies are set up for maximum cash value, we see them deliver and we have proof of performance as well. So the first reason why people choose them, one of the four major mutual companies. And the second reason has to do with their PUA flexibility. So that PUA rider is a means to maximize your cash value from start to finish. They are a company that will allow you to really commit to a minimum premium. So if you said, hey, I'm considering a policy and I'd like to be able to pay up to $10,000 per year, you can have a policy with Guardian where you commit very, very close to about $1,000 per year. That's what you're billed for each year. You could even pay that monthly if you want. And then at discretion, you can just throw money into PUAs, accelerating the cash value growth of a policy. But those are two simple reasons which really help refine a lot of people's decision-making process as we consider different companies and products. And everyone is different. We use Guardian, we use Mass Mutual, we look at other companies all the time. But in this video today, we are going to go through Guardian thoroughly, their different whole life insurance products, how to design them for maximum cash value, really anything and everything that has to do with whole life insurance specific to Guardian. This way, if you're considering a policy and you're trying to get just transparency, what is available with different companies and products, this video will provide transparency on only Guardian. We're not going to compare and contrast in this video. So let's get on into it. Beginning with their 2022 dividend interest rate. It is or will be 5.65%. That's actually the third consecutive year that they've paid a dividend rate of 5.65%, which is fantastic considering the ultra low interest rate environment we've been in. Now, depending on when you purchase that product, you will have a different guaranteed rate. For all products purchased in 2022 onward, for the most part, you'll see a 3% guaranteed rate. That's probably going to be the guaranteed rate you will have with a Guardian policy, unless you purchase their 10-pay product that has a guaranteed rate of 2%. I'm going to break down exactly how this surplus rate works with the guaranteed rate and how it results in the total dividend of 5.65%. And this will actually relate to any whole life insurance policy with any company. So if we look at their dividend history here, up top, you see their 2022 dividend interest rate, 5.65%. Everything below 2022 through 1980 there had a guaranteed rate of 4%. So from 1980 through 2021, products issued with Guardian, whole life insurance policy specifically, had a guaranteed rate of 4%. Now, that has changed actually beginning 2022, as we just mentioned earlier. Here's how I want to break it down though, is we're going to look at their 2021 dividend interest rate history, and the main reason why is that we've got their guaranteed cash value interest rate disclosed. So I have a guaranteed rate of 4%, but when I Google search Guardian's dividend interest rate, I will see 5.65%. So if you remember on the whiteboard, we had that surplus rating there, and it was different depending on the guaranteed rate. So all Guardian whole life insurance policies, regardless of when you purchase the policy, receive the total dividend interest rate of whatever it is for that year. In this case, 5.65%. So how it would work if you have an old Guardian policy with a 4% guaranteed rate, is you have a declared surplus, and guess what? The difference between the guaranteed rate and the total dividend interest rate. 4% guaranteed rate plus the surplus of 1.65% gives me 5.65%. If I go to a new product issued in 2022, here we go, total dividend interest rate, 5.65%. The guaranteed rate is what? 3%. So what this means is that the surplus would be the difference between the two, 2.65%. I actually like to back into it. That's how I will always calculate the number. And what I mean when I say back into it is first I will look at what the company's guaranteed rate is, 3% in this case. When they declare their dividend rate of 5.65%, take the total dividend interest rate minus the guaranteed rate, and that gives you your surplus. That's if you really like to break down a life insurance policy and have some fun with them. But that's what this piece right here means with the surplus rate. Let's continue on. So we're going to have different policy start dates here. I'm mainly going to focus on 2022 onward. So if you're considering a new whole life insurance policy, this video will apply mainly to that. However, I'm going to touch on some of their older products as well as we progress through this video. So Guardian is a direct recognition company initially when you open a policy. You do have the option to select or change your product to non-direct recognition down the road. But how they work with their loan interest rates, if you decide to borrow against the policy, is when you start a policy in 2022 onward, the fixed loan interest rate will always be a fixed rate, and the rate will be 5%. Now here's the fun part. At the 10th year, so once you've had a policy, you hit the beginning of year 10, Guardian will send you a letter. Our office, if you're working with us, our office will reach out to you as well and say, hey, it's policy year 10. You have the option to elect a variable loan interest rate, which has a current rate and a floor of 4%. Here's the thing though, if you select that variable loan interest rate, your life insurance policy is no longer direct recognition, and it actually changes to non-direct recognition. Quick refresher on that, direct recognition means that the company will directly recognize when you take a loan against the policy. They'll still pay a dividend to loan dollars, but it'll be an adjusted dividend. I'm going to go through Guardian's old product and their new one so you can see it side by side shortly. So, starts at direct recognition, fixed rate of 5%. If at year 10 you say, you know what, I want to go with the variable loan rate, it'll be variable. The floor, as low as it can go, is 4%. The policy is also now non-direct recognition. If you said, you know what, interest rates are going up, I don't want that variable loan rate. I'd like to stay with the fixed rate and keep it locked in. What will happen is the fixed loan rate will actually drop to 3%, and this occurs at age 65 or policy year 20. And it is whichever one comes last. So to illustrate, if you started a policy at age 50, in 20 years, you would be 70 years old. Would you receive that 3% guaranteed rate at 65 or year 20? Year 20, the later of age 65 or the 20th year, whichever one comes last. If you start a policy at age 30, 20 years from now, you'll be how old? 50. Does it drop to the 3% guaranteed rate? Fixed loan interest rate? No, it would not occur until age 65. So it's the later of the two. Now, we're going to demonstrate their direct and non-direct recognition treatment shortly. What I want to touch on first, though, is that Guardian, whenever I take a loan, they actually bill interest in advance and at a discount. So specifically what I mean when I say that is if I take out a $10,000 loan, at 5%, that would be what? $500. However, what I'll actually see hit my account, $476. So they bill loan interest in advance at a discounted rate, 4.76%, where they come up with these numbers. That part I don't know. But where I'm going with this is day one, if you take a $10,000 loan, you will find on your online account, when you say, okay, what's my loan balance? It'll be $10,476. Okay, what's going on here? Because I took a loan out today, when I look at loan interest and how it accrues in the life insurance industry, it accrues daily at annual simple interest. So what Guardian does is they bill the loan interest up front. However, it still accrues over the course of the policy year, meaning if I pay a loan off in 6 months, for example, the 6 months that they billed in advance but has not accrued yet because I'm paying the loan off early, I actually get a refund for the interest that was billed in advance that hits my cash value. We've got some other videos on that with respect to how loan interest works, but they do bill loan interest in advance. If you make any payments, you'll see a refund of interest that was billed in advance kicked back to your policy, or kicked back to your cash value, I'm sorry. So we're going to model both the fixed and variable. What I want to touch on first, though, is their direct recognition treatment. So if you have a policy and you don't touch it, you've got $100,000 in cash value, dividend interest rate is 5.65%, you will receive that 5.65% dividend on your full $100,000. Now, if you decide to take a loan against the life insurance policy, here's what will work. Let's assume that you take out $50,000. The fixed interest rate is what? 5%. Any loan interest goes to the insurance company, and you have $50,000 remaining in equity. Now, a beauty to cash value life insurance is that you will continue to earn dividends on the full $100,000. However, if the company's direct recognition, they're going to adjust the dividend that they pay on the outstanding amount. Here's exactly what Guardian does. Any money that's outstanding, that's still in cash value, they pay a 5.65% dividend interest rate. And then the loan balance, they pay a dividend to. However, it is going to be a loan rate or a dividend rate that matches the loan rate. So what we see right now is they actually lower the dividend rate to 5% on borrowed funds. Now, that applies to all policies purchased in 2022. What I want to touch on here is a very important piece, is if you purchased a policy from 2016 through 2021, if you already have one in force, your loan interest rate was what? It wasn't 5%, or it is not 5%. It is at 6%. Guardian does the same thing there, where if you borrow against the policy, they actually credit a 6% dividend rate on the borrowed funds. So now you get an enhanced dividend rate. So when I borrow and repay, I see my cash value fully restored plus a little bit more. With a new product, I see my cash value restored minus a little bit. If you were to go back to policies issued before 2016, it's even different back then. I actually have one of these where you've got an 8% loan interest rate. And they do the exact same thing. They actually increase the dividend rate on borrowed dollars to 8%. So really what Guardian does when it comes to policy loans is they do not want a policyholder to feel as if they're going to be punished for borrowing against that policy. They also don't want to punish themselves as a company or other policyholders that are not taking loans. So what they do is really call it a wash effect on paper. And I'll explain why I say on paper in a second. It's going back to the current, is if I have a 5% loan interest rate, which means they're going to adjust the dividend rate to 5%. When I borrow and repay, I will see my cash value restored minus a little bit because the dividend of 5% is obviously less than the 5.65% rate. Direct recognition in this case. However, a dividend rate, whatever that dividend rate is not the net rate that you are going to earn on the policy. Remember that a dividend rate is always the gross rate credited after the company's insurance expenses, mortality charges. What I want to look at is the net internal rate of return. What's the actual growth rate? And then I can compare that to the net cost to borrow. So let's look at both the fixed loan interest rate and also the variable loan interest rate. Let's have some fun with this one, depending on one's definition of fun. So a lot of sheets here. I'm going to start out with the direct recognition treatment. So anytime you are considering taking a loan against a life insurance policy, what I'm a huge fan of doing is looking at the life insurance policy and seeing what does that model look like when I just pay money into it and let it sit and grow, and then taking that exact same policy and showing what loans look like when I borrow against it and never pay back, if I pay interest only, if I fully repay it. That way I can have, call it full transparency on exactly how that loan impacts my policy from start to finish. So here we go. We've got the new product, 2022 dividend interest rate. Pulled this directly from the illustration, which we'll reference a little bit later. So this is a policy where we are funding it for 5 years, not a penny thereafter. If we want to continue to pay into it, we can, but we're going to stop after 5 years in this example. A lot of people like this strategy. It's a nice way to maximize the internal rate of return. Here's your annual dividend column. So one thing I want to touch on here, remember that we have a guaranteed rate of 3% and a surplus of 2.65%. What's important to be aware of is anytime you see a dividend column on a life insurance illustration, here's the actual illustration, here's the dividend column, same number there, that $5,086, that dividend column does not represent the guaranteed rate in the surplus. It only represents the surplus. That's the case with all life insurance companies as well. But very, very good to be aware of that, because when I see the term annual dividend, I'm going to assume the company's dividend rate of 5.65%, but that's not how it works in the insurance industry, unfortunately. But I do like to make that very, very clear because it avoids confusion. Getting back on track here. There's the payments. There's your dividend column. Breaking even, year 5. I've paid in 500. I have 500. This is based on the current dividend scale here. Now, we're going to look at the direct recognition loan. We can borrow against the policy anytime we want. Specifically with Guardian, what they require is anytime I make a payment, premium payment, a PUA payment, a loan repayment, whenever I make a payment toward the policy and that builds equity, cash value that I have access to, what Guardian's policy is they like to wait 10 business days before I turn around and borrow against the policy. They like to make sure that the funds have cleared from the bank account's end. So in this example, we look at a loan at age 50. I did it in year 11 because when we compare to the non-direct recognition example, we can go non-direct beginning year 10. That's why I did that. And age 50 just made it simple. There's the $300,000 loan. This again, remember, is direct recognition. 5% cost to borrow. The example on the left, the growth rate assumes what? A 5.65% dividend interest rate. This example, when I elect to take a loan of $300,000, what will happen? $356 remaining in cash value. Anything that is still in cash value continues to receive a dividend of 5.65%. The $300,000 I have borrowed, that continues to receive a dividend. However, it's a different dividend. In this case, 5%. So I'm still compounding on everything, but it's broken up into different segments. Whatever's still in cash value receives the standard dividend interest rate. Whatever is loaned against the policy receives a dividend of 5%, matching the loan interest rate. So often we get a question, how and why do insurance companies, or in this case, Guardian, how do they do that? Anytime you borrow against a life insurance policy, look at your death benefit and compare it to this example. What do you notice there? It's almost a clean $300,000 reduction. The loan interest is also withheld there, but when I look at the two numbers there, when I borrow against that policy, my death benefit is held as collateral. That is one of the major reasons how and why companies continue to credit dividends to any money in cash value and what I've borrowed against the policy. So in this example, here's really what I want to touch on. Before we look at the repayments, to isolate a drawback, a feature that many would view as unattractive here, so I'd like to go through everything. Here's your $300,000 loan. There's your loan balance. There's your loan interest. Here's the interest you're paying each year. and then there's the principal payment. So in this example, when the interest came due, we assumed it is paid. Now, what's 5% of $300,000? Be $15,000. So what's going on here? Remember where they bill that loan interest in advance at a discounted rate? That's where I've got the 14,286 from. So again, it's a discounted rate there. But here's what I want to touch on. Let's circle this in gold. This is a big reason I decided to keep the annual dividend column here. What do you notice there? In the example, when I take that loan against the policy, about $10,700, whereas in the example where I never touch it, about $14,000. That's a difference. The reason why, again, has to do with the reduced dividend credit to the outstanding dollars. Very, very important to be aware of that. Now, again, if you have an old policy, then you're going to see a different effect, which I'm going to touch on that in a second. But let's look at the impact here. I repay the loan at $50K per year. Cash value, $857, death benefit, $1,749 in death benefit. That's policy year 17. What do we notice over here? Policy year 17, $871, $845, $857, $740. There's a gap in the cash value. This example is less, again, because the dividend crediting rate on the outstanding loan balance was 5%, whereas anything in cash value was 5.65%. So in this case, if I'm looking at the cash value performance, it can hurt me a little bit. Good to be aware of that. Now, this guy tallies up the total interest payments out of pocket, about $50,000. One thing I'll add, which a lot of people, a lot of real estate investors and business owners we work with do this, is elect not to borrow against the policy. They'll often elect those cash value collateral loans, which is another great option to be aware of. But back to this example, when I loan and then repay, everything is almost restored, but I do have less right now. Now, if I look at the old guy here, here we go. So I don't want to spend too much time on this, but this is their old product, same design, had a lower PUA fee, so I have more cash value up front, earlier break-even point, but exact same scenario. And what do you notice here? Look at this, year 11, $657, dividend, $5,000 and change. Now, we take that same $300,000 loan against the policy. There's your cash value reduction. View that as the equity you have access to. Death benefits collateralized anytime you take a loan against the policy. There we go. But what do you notice on that dividend column here? Here's where it gets really, really interesting. It's higher. If you have an old Guardian product, you will see this occur with your policy. If it was issued between 2016 and 2021, it'll look very similar to this, where you've got that fixed loan interest rate of 6%. If you open the policy before 2016, you'll see a even higher crediting rate with an 8% dividend. Now also what that means is you have a higher cost to borrow too, and that's something we want to consider. So it's interesting when we really break that down, but let's go back to the new product. There we go. So that was with a loan coming out. This is direct recognition at age 50, new product. Let's progress on to the non-direct recognition treatment. So remember, at year 10, you have the option to select the variable loan interest rate, new product, 5.65%. Non-direct recognition, what's the loan interest rate? 4%. So this example will look very similar to the last one. Identical policy, $100,000 per year, going in for 5 years. There's your break-even point. Same thing over here, year 5. Death benefits, $2,050,000. I forgot to touch on the reason why. That gives us a MEC limit of $100K. Okay, perfect. Now, we elect to take a policy loan out. When we take a loan against the policy, I said out, sorry, when we borrow against the policy, dividends. What do we notice on these examples? $13,980. How about over here? $13,980. Is there any change? No, because we have elected to change the the interest rate to variable, and now it is a non-direct recognition policy. So what that means is when I loan and repay, what do you notice? Everything is 100% restored to exactly what it would have been as if I never touched it in the first place. Cash value and death benefit for that matter. So it's interesting when I look at the different loan options available to Guardian. What we did not model here is what things look like down the road from an income standpoint. Really, if you decide to keep that fixed interest rate, where it starts at 5% but eventually drops down to 3%, the advantage to that and why Guardian does that is from an income standpoint, especially when you look at pulling income from a policy and you look at a conservative dividend interest rate, or if you were to look just at the guarantees, that is a strength they have with their products. Corporations have forever used whole life insurance to create retirement benefits, really for high-level executives. Some companies do it for everyone. But where I'm going with this is when you look at how corporations set policies up for their executives and then eventually pay that income out to them down the road, having that fixed loan interest rate at a very low rate gives them the ability to pull more income from the product, especially in a guaranteed interest rate environment. Meaning they want to know, hey, if things go worst case scenario, not according to plan at all, what can I expect? And yeah, I think it'll do better, but set expectations really based on the guarantees and worst case scenario. That's where a low fixed interest rate really gives them a nice advantage. So a lot of information there. The rest of it will go a bit quicker, I promise. Let's move on to the next part. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.